Hi, I'm Joe Quinlan, Head of Market Strategy for the Chief Investment Office. We're continuing our 2026 mid-year outlook conversation with a deeper dive into the topics that dominate market behavior so far this year: geopolitics. Events like the conflict in the Middle East and regime change in Venezuela have stirred market volatility, but nothing looms over the long-term view of the markets and the world economy quite like the rivalry between great powers, the United States and China. Whether it's trade, chips, artificial intelligence, Taiwan, there are so many areas to discuss. So I'm happy to be speaking today with Larry Di Rita, Head of Public Policy for Bank of America. Larry, thanks for joining me.
Thanks a lot for having me, Joe.
Let's just get right into it. U.S., China, just saw the summit between President Trump, Chinese leader. What should investors make out of the outcome?
This is one of a series. There's going to be another one later this year. There was one last year. And this is an attempt by both countries, frankly, to keep the tensions manageable between the two countries, between our interests, which are not in line entirely. And so what you saw at this most recent summit is, I think, as much as anything, an attempt to avoid difficult, controversial issues. There were certainly discussions about the things that matter most to each country, trade in the case of the U.S., in some cases the issue of the Indo-Pacific security. But both sides are trying to maintain sort of a sort of controlled tension that's manageable between the relationships. And that's not a bad thing for markets, for the economies.
What about the thesis that we're decamping or decoupling? Is that really realistic for two big, huge economies that disengage?
I think there's been an evolution in thinking around that, more towards de-risking for both sides. Both sides are looking to de-risk their economies from each other, knowing that both economies are highly linked. They're linked to each other. They're linked to the global economies. In the case of the U.S., companies are looking for a China plus one or a China plus two type strategy, where you've got a supply chain that you can manage that doesn't depend entirely. We saw during COVID, you couldn't get masks anywhere but China, just to pick an easy example. So you're seeing an evolution away from that, which is probably good for everyone.
So here we are at mid-year point. How does the Middle East factor into U.S. public policy between now and in a year and beyond, in your opinion?
There's been a significant shift in the landscape in the Middle East going over many years. The first Trump administration, to some extent, sustained during the Biden administration, and now accelerated. With the Abraham Accords, with shifting relationships, we're seeing shifting relationships within the Arab world. The Saudis and the UAE are developing a bit of a almost competitive attempt for leadership in the Arab world. The role of Iran throughout the Gulf region and throughout the Middle East has been substantially altered because of the U.S. and Israeli war with Iran. I think the war has impacted a little bit of that shift, because there's now questions about just how safe is this region for people to want to invest in, for young people to want to go live there, et cetera. So the Arab states are going to have to figure out how to move beyond that.
Let's round out this conversation with China. Rare earth minerals.
Yeah.
China has a chokehold, so to speak.
Yeah.
How does that play out? What's the U.S. policy response?
That's another area where diversification is going to be necessary, and we're starting to see that. The U.S. administration has embarked on something called Pax Silica, where they're trying to develop coalitions to kind of transcend the dependence on rare earth processing that China has a monopoly on, or a significant market share on. President Trump has said it's not that we have a rare earth shortage, we have a rare earth processing challenge, and that's correct. And so are there ways through coalitions and, from mining to finished products and compute, is there a way to kind of transcend the dependence that the world has on China's processing? And we're seeing movement in that direction, but it's a long way to go, and China clearly has an advantage in that area. I would turn that around on you, though, and I'd just ask you, given this superpower relationship, as many have called it, what's the market opportunities? Are there opportunities that develop as a result of managed competition between the U.S. and China?
Well, from the CIO perspective, we're talking about, say, U.S. technology leaders, but we're also talking in the same breath China technology leaders. Yeah. And we're own both. You can own, as a retail investor, you can own both China tech and U.S. tech, because they are the predominant leaders in artificial intelligence, quantum computing, cloud services. So we're looking at both of the opportunity set. Another one we're looking at, the United States is very strong in life sciences. So is China, building out their medical science apparatus as well. So there's ways to kind of it's not either or. That's how investors shouldn't look at it. That's how we look at the CIO. It's like, what are the best companies in these growing sectors, in both countries that you want to have exposure to.
So even with that in mind, on AI in particular, you mentioned AI, do you see one body of technology having an advantage over another, China versus US? Is that the right way to think about it even?
We're looking at it very carefully, Larry, in the sense that the large language models how much out of China, a cheaper version, less computing requirements, what would that mean for the US in terms of the large language models, the leaders here, and all the computing power demand that we need vis-a-vis the data centers? It's a very interesting race. It's getting more intense, a lot of money being spent. The biggest issue is what large language model is going to be used outside of China and the US, right? There's a lot of people out there, 6 billion people plus in India, the Middle East, Europe. What are they going to adopt? Is it going to be the US standards models or the Chinese standards? Maybe a little bit of both, but to be determined.
Is that also the case with critical minerals? Is there investable opportunities in both China and the US when it comes to critical mineral strategies as well?
In the U.S. in particular, you're seeing, you know this, you're sitting in Washington, the more public or government activism in U.S. companies taking shares that are very strategic. But we're also seeing opportunities in Brazil, parts of Europe. They have rare earth minerals, the processing capacity that's coming on board. So as you know, there's a kind of a coalition being built in and around the U.S. and their allies to increase rare earth minerals production and the refining. So really, the rare earth story goes beyond just the United States and China. It's Latin America and parts of Europe.
You know, you mentioned Brazil, you mentioned other Latin America. I saw something you wrote recently about sort of how to rethink the whole idea of emerging markets. In other words, the asset class that people have gotten comfortable with.
Well, it brings us back to artificial intelligence, number one, because the emerging markets are having a phenomenal run this year, after last year as well. But when you kind of peel it back, there's 3 companies, 2 in South Korea and 1 in Taiwan. Many of us know who they are, that they're AI-driven components, right? They're sending a lot of product to the United States, AI-related to build out. They're just tremendous amount of activity, tremendous amount of upside earnings potential. So number 2, the emerging markets is an asset class. It's very heterogeneous, right? It's not one, it's many. So you got a bucket of countries that have different levels of economic growth, democracies, other political models. So we're telling investors, buy a company in this country that does what they do well, whether it's banking, processing food, agriculture, minerals, artificial intelligence. So just be more discerning when you're investing in the emerging markets.
Yeah. What are we not thinking about that we should be in terms of the risks out there, and then maybe flip it around in terms of the opportunity?
Well, I'm going to ask you that too, since you're sitting at the epicenter of policy uncertainty. I think, honestly, Larry, I think kind of the geopolitical factor that's missing is just the political dysfunctionality of the U.S. We hear that a lot from our clients. A lot of our clients very bullish on the U.S. economy. They like the earnings outlook, but politics is interfering. This is one reason, not the only sole reason. There's about $8 trillion sitting in money market funds right now. And when you speak to clients, they're like, why are you still in cash when we're in the middle of one of the strongest bull markets in history? They say, I'm worried about the politics, or I'm going to wait until we get some more political clarity. That's number one, just here at home. Number 2, keep your eye on Ukraine, Russia, because that is becoming a very interesting backdrop. We're all focused on Iran, right, and straits. But what is Russia doing? Will they go beyond Ukraine? If you talk to the Europeans, that's top of mind. Yeah. And therefore, you're seeing a lot of defense spending, a lot more spending on drones, surveillance, cybersecurity.
Yeah. Interesting. Yeah, you mentioned the Ukraine, Russia. I worry about, I will tell you, at the beginning stages of the invasion of Ukraine, there was a lot of new sanctions being put into place. It was luckily most of the large U.S. companies, there were some exceptions, didn't have tremendous exposure in Russia, so it took time to unwind all that. I do worry of a future conflict where there's sanctions placed on much larger economies. We've talked about the U.S.-China competition that's going on. You could see backing into some sort of tension period where sanctions and other tools like that are applied. I think a much greater challenge for markets to have to adjust to if there were sanctions at the level we saw in Russia applied to a much larger economy. And that's one of the things I think about right now.
Well, related to that, Larry, the elephant in the room, China, Taiwan.
Yeah.
Do you worry about that happening, that they make a move, the mainland makes a move on Taiwan, that catches the markets off guard, or they worry about semiconductor production? So how do you process that when you're talking?
The interesting thing about the Taiwan situation is that both the U.S. and Chinese economies depend heavily on a sole source of capability in Taiwan. So in many ways, Taiwan's sort of the third superpower. And both the U.S. and China recognize that. So the current policy is no change to the status quo unilaterally. In other words, if the status quo is to change, it has to be agreed upon by all the parties. And if everybody can, if both sides, the U.S. and China, remain in that posture, then hopefully we can kind of manage through this period of tension. I think, and you can speak to military experts and military analysts, the challenges to a military operation in Taiwan for China are quite significant, and China certainly understands that, including the fact that they haven't had a military campaign in our lifetimes.
So no shortage of geopolitical tension
we'll
points.
be back to talk some more.
I know, never a dull moment. Thank you, Larry.
Thanks a lot for having me, Joe.
Sure.
Appreciate it.
This conversation has been eye-opening. The relationship between the U.S. and China is very much intertwined. The next few months on the world stage will be so important for investors to watch. Please do keep your goals in mind as you navigate the volatile environment we're in. Don't miss the Mid-Year Outlook webcast, and if you have any questions, please speak with an advisor if you have one. Thanks for watching.